The rules of money are changing right in front of us, and most people won't notice until it's too late. We're not in a normal market cycle. We're watching one of the biggest money traps in history deploy in real time, and the warning signs are everywhere if you know the pattern. Millions of investors believe they're participating in wealth creation through long-term investing, but the mechanics underneath have quietly transformed into something fundamentally different. Speculation disguised as investment, leverage masquerading as strategy, and prediction replacing analysis. Here's the paradox. Markets are at or near all-time highs. Volatility appears controlled, and mainstream advice promotes staying invested for the long term. Yet simultaneously, margin debt is at historic levels, retail options trading has exploded, and speculative positioning exceeds any point in history. When leverage and short-term speculation dominate markets but are marketed as democratized investing, you're not watching innovation, you're watching a trap being set. I'm going to show you a pattern so reliable, so mathematically precise, that once you understand it, the current market environment transforms from confusing volatility into a predictable wealth transfer mechanism. It's called the three-stage investment cycle trap. We are deep into stage 3 right now, mass speculation. Disguised as investment, the phase where millions believe they're investing conservatively while actually taking leveraged, derivative-based bets they cannot afford to lose. Let me define the mechanism. Stage 1 is genuine investment and fundamental value creation. The cycle begins after a major market reset, a crash that cleared speculative excess and reset valuations. During this stage, investors buy assets based on cash flows, dividends, and tangible value. Leverage is minimal. Returns come from business growth and productivity gains. The language is cautious, patient capital, margin of safety. This stage can last years, characterized by skepticism and reluctance to take risk because memories of the prior crash remain fresh. Stage 2 is leverage expansion and language corruption. As stage 1 investments generate returns, confidence builds. Financial innovation introduces new instruments marketed as sophisticated tools, but functionally they're leverage and derivatives. Margin borrowing expands, options trading increases. Critically, the language shifts but remains superficially prudent. Portfolio optimization, risk-managed strategies. The public is told these are modern investment techniques, not speculation. During this stage, returns accelerate not from fundamental value, but from leverage amplifying price movements. Stage 3 is mass speculation disguised as investment and elite repositioning. Leverage reaches historic extremes. Derivatives outstanding exceed underlying asset values by multiples. The average participant is taking risks they don't understand, buying options with expiration dates, using margin, investing in assets with no cash flows based purely on momentum. But the language has been completely corrupted. This is called democratized finance, retail empowerment. Meanwhile, the architects, sophisticated institutional investors, and corporate insiders are quietly repositioning. They're reducing leverage, selling speculative holdings, converting to cash or hard assets. The trap is fully set. Maximum retail participation at maximum leverage right before the mechanism reverses. Now let me prove this pattern with two historical cases. The first is the dot-com bubble of 1995-2000. Stage 1 was the early internet investment period from 1990-1995. After the 1987 crash, genuine technology investment began. Companies like Cisco and Microsoft were building real businesses with revenues and earnings. Investors buying in the early 90s were making genuine investments based on fundamentals with minimal leverage. Stage 2 was 1996-1998. Financial innovation introduced tech-focused funds, momentum strategies, and margin accounts marketed to retail as portfolio leverage. The language shifted. New economy paradigm, democratizing wealth creation. Online brokerages advertised that everyone could be a trader. Speculation was rebranded as sophisticated investing. Stage 3 was 1999-2000. The average retail investor believed they were making prudent investments in the future of technology, but the mechanics were pure speculation. People bought companies with no revenues using margin. Day trading became mainstream, marketed as empowering ordinary people. Meanwhile, corporate insiders were selling at record rates, billions in stock while retail bought. When the crash came, it wiped out $5 trillion, but the wealth wasn't destroyed. It transferred from retail speculators to insiders who sold into the mania. The second case is the 2003-2008 housing bubble. Stage 1 was 2001-2003. After the dot-com crash, capital rotated into real estate. Early buyers purchased homes with traditional mortgages and 20% down. These were genuine investments based on tangible value. Stage 2 was 2004-2006. Financial innovation introduced subprime mortgages, no documentation loans, and CDOs. Leverage exploded. Buyers could purchase multiple properties with 5% down. but the language remained prudent, expanding home ownership, democratizing real estate investment. Media promoted participation through shows like Flip This House. Stage 3 was 2006 to 2008. Ordinary people believed they were making prudent real estate investments, but they were taking leveraged bets they couldn't afford, buying properties with no money down, planning to flip them in months. This was speculation, but the language called it building wealth. Meanwhile, the architects were exiting. Large investment banks began shorting the very mortgage-backed securities they'd created. By the time the crash came in 2008, institutional capital had repositioned to profit from the collapse, while retail participants faced foreclosure and total loss. Both cases show identical mechanics. Genuine investment transforms through leverage and language corruption into speculative mania, where ordinary people take catastrophic risks, while sophisticated capital repositions before the trap springs. Now, here's why we're watching the biggest iteration of this trap in history. Stage 1 was the post-2008 period from 2009-2015. After the financial crisis, genuine value investing opportunities existed. Investors who bought carefully made genuine investments with minimal leverage. Stage 2 was 2016-2020. Financial innovation introduced zero-commission trading apps like Robinhood, fractional shares, and options trading marketed to retail as income strategies. Margin debt expanded, but the language remained prudent, democratizing finance, empowering retail investors. Stage 3 is right now. The average retail investor believes they're participating in long-term wealth building, but the mechanics reveal pure speculation. Retail options trading now represents over 50% of total options volume. Individuals buying weekly expiration contracts. Margin debt exceeds $800 billion. Crypto speculation, marketed as investing in innovation, involves assets with no cash flows. But here's the critical signal. Corporate insiders are selling at record rates, over 100 billion liquidated in the past year. Warren Buffett's Berkshire Hathaway is holding record cash levels over $325 billion rather than deploying into markets. Sophisticated family offices have increased allocations to cash and defensive positioning. The architects are exiting while retail participation reaches all-time highs. Let me check the boxes. Has leverage reached historic extremes? Yes. Margin debt over $800 billion. Has language been corrupted to rebrand speculation as investment? Yes. Democratized finance describes leveraged gambling. Is retail participation at maximum levels? Yes. Options trading, crypto, meme stocks at record retail volumes. Are sophisticated investors repositioning? Yes. Insider selling at records, Berkshire holding maximum cash. Stage 3 is fully deployed. Here's what mainstream media won't tell you. They promote that retail investors are finally getting access to institutional strategies. That language is exactly how Stage 3 traps operate. The truth is, retail isn't getting sophisticated strategies. They're being sold leveraged speculation. When someone buys weekly options with 10x leverage, they're not investing. They're making a timed bet that will likely expire worthless. When Stage 3 traps spring, they don't announce themselves. The reversal comes suddenly, a volatility spike, a margin call cascade, and leveraged positions get liquidated in hours. The wealth doesn't disappear. It transfers from leveraged retail speculators to institutional capital that repositioned early. The urgent message: examine your portfolio honestly. If you're using leverage, buying assets with no cash flows, holding positions with expiration dates, or investing based on momentum rather than fundamental value, you're not investing. You're speculating in a trap that has destroyed wealth repeatedly throughout history. Pattern recognition beats prediction. And the pattern is screaming that we are in Stage 3 of the biggest investment cycle trap in history. More retail capital is taking more speculative risk with more leverage than ever, while sophisticated capital repositions defensively. The trap is set, the architects are exiting, and when it springs, millions will discover too late they weren't investing for the long term. They were making leveraged, time-sensitive bets in the most dangerous phase of the cycle. Position yourself accordingly.